Welcome to Chapter 10 homework. I'll start with computational exercise number 12. And you can see here on the page it says Inercio contributes 100,000 in exchange for 40% interest in the calendar year ABC LLC, which is taxed as a partnership. This year the LLC generates 80,000 ordinary taxable income, has no separately stated income or expense. Inercio withdrew 10,000 from the partnership during the year. It says, is he taxed on the amount of ABC's income on how much of the 10,000 distribution will he be taxed? It's a very straightforward question, thankfully. But as you know, the chapter is about partnerships, formation, operation, and basis. And so all the questions kind of deal with that. So let's kind of think through what happens for Inercio here. So he has a 40% interest in the partnership. That means he gets 40% of the income on which tax will be paid. So he gets 40% of $80,000, which is $32,000. So that $32,000 would be taxable income to Inercio. Remember, that flows through on his K1 to his personal tax return as taxable income. The $10,000 distribution, though, is not taxed because the distribution is less than his basis in the property before the distribution is made. So he's only taxed on 40% times 80,000, which is 32,000. He is not taxed on the 10,000 partnership income because the basis, I should say, or let me say that right, the $10,000 withdrawal because it's lower than his basis. Okay, question 17. Henrietta transfers cash of 75,000 and equipment with a fair market value of 25,000 in exchange for 40% profit and loss interest worth 100,000. So question A, how much of Henrietta's realized and recognized gains and losses? Let's look at that one first. And take a look at what she gave in versus kind of what she gave up. So it's important to kind of see here that she gave cash and equipment. The equipment had a fair market value of 25 and a basis of 10. And so she does have a realized gain of the difference between 25 and 10. That is a realized gain, which is right here. So she has a $15,000 realized gain. However, she does not have a recognized gain, meaning it wouldn't be taxable at this point in time because she's forming the business, which is usually the case. So realized gain of 15, recognized gain of nothing. For part B, what is the amount of Henrietta's basis in the partnership interest? It's the $75,000 of cash plus the $10,000 of the basis in the property. So 75 plus 10 for 85. Then for part C, what is the partnership's basis in the contributed equipment? The partnership has what they call a carryover basis of 10. So the partnership itself inherits the $10,000 basis that existed for Henrietta as a sole proprietor. Now that just simply transfers over to the business. Okay, that was question 17. Question 18, it says that Wozniak and Wilcox formed Jewel LLC, with each receiving a 1/2 interest in the capital and profits. Wozniak receives his 1/2 interest as compensation for tax planning services he rendered prior to the formation of the LLC. Wilcox contributes 50,000 of cash. The value of a 1/2 capital interest of the LLC for each of the parties is 50,000. For part A, how much income does Wozniak recognize as a result of the transaction, and what is his character? So remember what Wozniak did. He gave the partnership, Jewel, tax planning services he rendered prior to the formation. Okay, so he contributed services, and because in exchange for services, he received a $50,000 partnership in the property. Wozniak treats that as taxable income. That's taxable income for him. It's ordinary compensation. So just as if he'd been paid cash, the difference is he was paid an ownership interest in a partnership instead of cash. So $50,000 taxable income. at ordinary compensation. And then for part B, how much is his basis? Well, his basis is the value of his labor, basically the services he provided, which is $50,000. Okay, so his basis is $50,000. How will Jewel LLC treat the amount? Jewel will treat the amount basically for Jewel. Think of it like this: it needed tax planning services, so it would have paid somebody for that if Wozniak had not contributed that in exchange for an ownership interest. Okay, most likely we would treat that as an organizational or startup type of an expenditure, which we'll talk about here in a little bit. Okay, question 19. It says here on January 2nd of the current year, Fenton and Myers form FM LLC. Their contributions to LLC are as follows, and you can see here cash. Fenton gave cash, receivables, and inventory, and Myers gave cash. Over here on the fair market value side, notice that the sum of these three equals 200,000, just like it does right here for Myers. So within 30 days, FM collects the receivables right here and sells the inventory for 60,000 of cash. How much income does FM recognize from these transactions, and what is its character, and why does this result apply? So it does recognize $90,000 of ordinary income upon collection of the cash basis receivable, so that will be income. It also recognizes $35,000 of ordinary income upon sale of the property, the inventory, which is 60 minus 25 is 35. So 90,000 income from collections of receivable, 35,000 income from selling off the inventory. So the reason this rule exists, so it says the rule exists to ensure that a partner in partnership cannot transfer property between themselves and alter the inherent character of the underlying deferred income, gain or loss, or deduction. So it would have been income as it was collected as a receivable, and it would have been income as inventory was sold by Fenton. And just because it now belongs to the new LLC doesn't mean we treat it differently. We treat it the same. So that was question 19. We'll take a look at the next one here. So next is question 20, and it says here that Candlewood LLC started a business on September 1. It adopted a calendar tax year. During the year, Candlewood incurred $6,500 in legal fees for drafting LLC's operating agreements and $3,000 in accounting fees for tax advice of an organizational nature, for a total of $9,500 of organizational costs. Candlewood also incurred $30,000 of pre-opening advertising expenses, $24,500 of salary and training costs for new employees before opening the business, for a total of $54,500 of startup costs. They want to take the largest deduction available for these costs. So how much can they deduct as organizational expense, and how much as startup expense? So we'll do the organizational expense first and go from there. So take a look at what was organizational expenses, and you can see it's up here. The $6,500 legal fees, the $3,000 accounting, for a grand total of $9,500. So kind of focus on those three things first and then go from there. So there's a rule for that. So they're going to be allowed to deduct. I'm going to go to Excel to do this one. So $5,100 is what they're going to be allowed to deduct. How do we get to that number is the question. So basically, with organizational costs and the first 5,000 of organizational costs is deducted, and the remaining is amortized over 180 months. Okay? So we have grand total of 9,500 of cost. We're going to subtract from that 5,000. The difference, of course, is 4,500. We're then going to amortize that 4,500 by 180 months. So I'm just going to put in 180. So $4,500 divided by 180 months. Okay. Now for the current year, they have 4 months. So if we go back to the question, September 1 this started, so think September, October, November, December. That's obviously 4 months. So I'll take the $25 per month that I can take times 4, which is $100. The question is, the answer is 5,100. I can take the initial 5,000, or I can take up to 5,000 plus I can start amortizing. So I get 4 months of amortization. So it's $5,100. And that is for organizational costs. Okay. Then I have the startup costs, and the grand total will be 1,700. Okay. Let's go back to the numbers from the question. And it says here 30,000 pre-opening advertising, 24,500 of salaries, and for a grand total of 54,500 of startup costs. So grand total of 54,500. And what we do, what we're allowed to do is take the first 500 is what we're allowed to take. And so we'll take the 54,500. We'll subtract 500, and that gets us to $54,000 for the difference. We then amortize that again over 180 months. And then I just simply do some division again. And then I multiply that by 4 months. So 4 months is what I have. I'll take 4 times the 300, and I get 1,200. So the answer, remember I said, was 1,700. That's 500 that I can take up front right away, plus the $300 a month amortization. So 500 plus 1,200 is my 1,700. That's how I solved those two, or both parts of question 20, I should say. Question 21 says that Penguin LLC operates a large apparel store with several employees and substantial debt. Each LLC member is active in the business and receives compensation from the LLC. The LLC invests in excess cash in government and corporate bonds, blue chip stocks, and a global mutual fund. If it owns property subject to accelerated depreciation, what types of information must it accumulate and report on its Schedule K-1? Okay, so a very big open-ended question, and I will just tell you, all you have to do is go to the chapter and take a look at the K-1. Okay, so that's all you have to do. It's on page 28 of the chapter, and these never really organized very well. I don't have this right in front of me to know exactly which is page 28, which is the K-1. But just find the K-1 in the chapter, and once you find the K-1 in the chapter, that will answer the question. It's really that simple. It's just a matter of looking at the K-1 and then knowing exactly what to put on there. Okay, so that's really all you have to do. Okay, I should have had the K-1. I always write down page numbers, and I forget that you can't actually really easily search page numbers in this particular book. So my bad for that. But page 28 is where you'll find it. You'll find the K-1. Once you flip to the chapter, you'll find the K-1. And really the answer is what's on the K-1. That's the answer to the question 21. So let's kind of think through. Now, I'll go look at it, and I know that you will. But things that are on it are things like what's the ordinary income, what are guaranteed payments, excess interest expense, investment income, gains or losses would be on there, net earnings from self-employment, if they have a foreign tax credit, not every business would, information about the alternative minimum tax, the AMT might be on there, investment income and expenses, and those would be probably the main ones. But again, just look at the K-1 and you'll definitely understand it. Okay, question 22. This year, Tasty Partnership reported income before guaranteed payment of $92,000. Stella owns a 90% profit interest and works 1,600 hours per year in the business. Euclid owns a 10% interest with the basis of 30 beginning of the year and performs services for the partnership during the year. For services performed during the year, Stella receives a salary of $6,000 per month, and Euclid withdrew $10,000 from the partnership during the year as normal distribution of cash from Tasty, but not for services. So for part A, what's the amount of guaranteed payments made by the partnership? Very simple answer. We're paying $6,000 a month to Stella right here. So that is it. So the quote-unquote salary for services performed is my guaranteed payment, 6,000 times 12 for $72,000. For part B, how much is the partnership's ordinary income after permitted deduction for guaranteed payments? So it says up here at the beginning, income before guaranteed payment of 92, then minus the 72,000 from part A equals 20,000. So B is 20,000, which is 92,000 minus 72,000. For part C, how much income will Stella report? Well, obviously she gets the $72,000. That's hers right off the top. And then 20,000 is left over. So of the 20,000 left over, Stella gets 90% of that. So she gets 18,000. So let's do the math on that. So she gets 20,000. That's the income, and she's a 90% owner. So let me get the formatting here just correct. So she gets 20,000 times 90%. She gets the 18,000 plus the 72,000 guaranteed payment. Okay, she gets that. So the grand total between the two is 90,000. So 18 plus 72 is 90, and that's what she gets. Then Euclid gets the rest. So basically, Euclid gets what's left over, and so Euclid is a 10% owner, and so Euclid gets the income of 20,000 that's left over times 10%, which is 2,000. So Euclid gets 2,000. Now Euclid also took money out right here, 10,000 out. That is a withdrawal, and the basis is higher than the draw. That's the key here. So the draw was 10, basis was 30. So because of that, there's no tax for Euclid on that. So Euclid only pays tax on the 10% share of $20,000 income, which is $2,000, and that's where that ends. Okay, the next question is question 23. It says here that when Paget Properties was formed, Nova contributed land, value of $200,000, basis of 50, and 100,000 in cash. Oscar contributed cash at 300,000. Both partners received a 50% interest. So for part A, for question 23, how was the land recorded for 704B book capital account purposes? Basically, it's just recorded at its value, which is $200,000. So it's no strange twist or anything like that there. So the answer to A is $200,000. For B, so this is Paget Properties LLC. What is Paget's tax basis? Well, it receives the carryover basis from Nova of 50. So the basis is 50. For part C, if Paget sells the land several years later for $300,000, how much gain will Nova and Oscar report? Let's assume it sold for $300,000. If that's the case, Nova reports a gain of $200,000. Okay, so Nova reports a gain of $200,000, and Oscar's gain is $50,000. So I'll show you how we came up with that. So we had pre-contribution gain. Okay, so the pre-contribution gain is 50,000, and so you can kind of see here. Let me show you I'll show you how that works in Excel. It'll be easier. So let me just kind of erase some stuff here, make some room, and we'll go from there. So Nova, let me just write that down here. Nova has a gain of 200,000, and Oscar's gain is 50. There's a pre-contribution gain. Okay, right here. And the pre-contribution gain is the 200,000 value minus the $50,000 basis. Okay, so whoops. Not enough zeros there. There we go. Okay. So that is my pre-contribution gain of 150. Okay. And then 50,000 of that gain goes to Nova. So Nova again will inherit 50,000 of that. Okay. So the pre-contrib gain is 150, but Nova gets 50,000 of it. And so the post-contribution gain, let's go back to the question. The post-contribution gain is the value of 200,000, and then we sell that for 300,000. And so they split that. They each get 50,000. Okay, so the post-contribution gain is 100,000. It's the 300,000 minus the 200,000. Okay, that's $100,000. So Nova gets 50,000 of the post-contribution gain and 50,000 of the pre-contribution gain. Okay, that's basically how the answer works. Okay, we'll go back to question 24. At the beginning of the year, Barnaby's basis in the Triple B partnership was 50,000, including his 5,000 share of debt. At the end of the year, his share of debt was 8,000. His share of the partnership income for the year was 20, and he received cash distributions of 12,000. In addition, his share of the partnership's non-tax income was 1,000. How much was his basis at the end of the year? Okay, so his initial basis, remember, was 50,000. Let's go and take a look at that. So this is for Barnaby. So 50,000. Okay, and then that 50,000 is increased by the 3,000 share of debt. Okay, and they told us that the debt was 8,000 ending and 5,000 beginning. So you can just kind of do this: 8,000 minus 5,000, and that gets to 3,000. And he also receives 20,000 of income. And then they took out 12,000 for a draw. And that's how you do it. Pretty straightforward. So the answer is 61. Actually, I'm sorry, I'm not quite right. And then also there was $1,000 of tax exempt income. Well, I should have included that for 62,000. Okay, so if I didn't mean to forget that last one. So let me just kind of do it this way. That'll make a lot more sense. So let's add them all up together, top to the bottom. So the initial basis was 50, increase in liability of 3, income of 20, withdraw of 12, and then the $1,000 is tax exempt income, and the sum of all those is 62,000. Okay, so that was for Barnaby right here. For 25, we'll do Alicia and Ezra, equal partners, contribute property to form double E partnership. Alicia contributes 200,000 cash. Ezra contributes a building and land with adjusted basis and fair market value of 340, subject to a liability of 140. Partnership borrowed 20,000 to finance construction of a parking lot in front of the building at the end of the year. The actual basis partnership owes 8,200 in trade accounts payable to various creditors. The partnership reported net income of 30,000 for the year. Assume that Alicia and Ezra share equally in partnership liabilities. How much is Alicia's basis in the partnership interest? And then how much is Ezra's? So let me just kind of erase a bunch of numbers here. This will be easier. We have a kind of a blank slate. So let's do Alicia first and take a look at her numbers. These are pretty straightforward. So she put in the cash. Okay. Then we have to kind of look at half of everything from there. So Alicia put in the cash, and then they're splitting everything equally. So then she's going to split the liability on the property. So that's 70,000. They also had construction debt at 20,000, so we're going to split that at 10,000. There was an increase in accounts payable. Right here it said 8,200, so I'm going to have half that. And then the income was 30,000, and they get half that, so 30,000. Add those up, we get 290. We get let's see. Okay, I was putting some wrong numbers in here, so I confused myself. So 200,000 initial cash, 70,000 liability for the land. That's half the total of 140. 10,000 is half of construction debt, which was 20,000 in total. 4,100 is the increase in accounts payable, half of it, totals 8,200, and 30,000 was the total income, half that's 15, grand total of 299.1. And the same story for Ezra. Except Ezra did not put cash in. Instead, Ezra put in a building, fair market value of 340. I should say building and land in actuality. And then subtract from that the debt associated with it. So minus 140. And then kind of from there, kind of the same thing. Half the liability comes back, and then half of the construction debt, half of the accounts payable, half of the income. So add those all up, and we get the same number, 299,100. Okay, so that was question 25. Let's take a look at question 26, which is right here. Jocan contributes a non-depreciable asset to the Mahali LLC in exchange for a 1/4 25% interest in the LLC's capital profit and 30% interest in its losses. The asset has an adjusted book tax basis to Jocan and the LLC of 60,000 and a fair market value and book basis on the contribution date of 150. The asset is encumbered by a non-recourse note of 40,000 that has not been guaranteed by any of the LLC members. How much of the non-recourse debt is allocated to Jocan, and what is the amount of his basis in the LLC interest following the contribution? So let's take a look at this here. And so the answer is he has a 10,000 share in the debt and a 30,000 basis in the LLC interest. Okay, so let's kind of take a look at how we'll get to that. So basically we take his initial basis right here of 60,000. So let me get rid of this stuff here. We'll just put it right here. So this is Jocan. We'll just say J. Starts out with 60,000. Okay, and then we're going to make some adjustments to that. So that 60,000 for Jocan is adjusted by 40,000 of debt assumed by the LLC. Then Jocan's allocated basically 25% of that debt. So if you can see the 40,000 right here, 25% of that goes to him. So we'll go 40,000 times 0.25, his interest. So that's 10,000. And then the resulting basis is 30,000. Oops, I'm sorry, I got ahead of myself. Let me start over with Jocan here. So his initial basis is 60,000. Okay, so they told us that right here. And then we subtract from that the note of 40,000. Okay, so we add 60 minus 40. We then add back to that 25% of the 40, which is right here to get to 30,000. So the answer is 30,000. So basis minus the full amount of the debt plus 25% of the debt. You get down to 30,000. Okay, I'm skipping 27, so I'll go to 28. Heather sells land, adjusted basis 75, fair market value 95, to a partnership in which she controls an 80% capital interest. The partnership pays her only 50,000 for the land. How much does Heather realize or recognize? Let's do that one first. So basically, she incurs no deductible loss. Okay, at the original sales date, Heather had a realized loss of 25,000. which is $50,000, the $75,000 basis, I should say, minus the $50,000 selling price. That's $25,000. It's a related party, so it's not deductible. So she incurs no deductible losses. So there was a loss of 25, but because it's treated as a sale of a related partnership, there's no loss that she's allowed to take. For Part B, if the partnership later sells the land to a third party for 80, how much gain does the partnership realize and recognize? Later would have a $5,000 gain because that'd be 80,000 fair market value, which is higher than the basis of 75. Okay, the partnership has a 5,000 gain. When it sells the land to an unrelated party for 80,000, that's basically what happens is they get to take that $5,000 gain. Okay, so kind of just keep that in mind. That comes in after they sell it to an unrelated. Take a look at 29. So some of the problems now. It says here that Emma and Lane form equal EL partnership. Emma contributes cash at 100. Elaine contributes property with a basis of 40 and fair market value of 100. For Part A, how much gain, if any, must Emma recognize on the transfer? And then must Lane recognize any gain? If so, how much? Excuse me. At this point in time, hopefully you kind of know that when you have these contributions to a partnership that there are no gains. Okay. So neither the partnership nor the partners recognize any gain on formation of the entity. For B, what is Emma's tax basis in her partnership interest? For Emma, it's $100,000. Okay, so for Emma, she contributed cash of 100. Her basis is 100. For Part C, what is Lane's tax basis on the partnership? So she takes a substituted basis of 40,000 in her partnership interest. And her book basis, though, is the fair market value, which is $100,000. So substitute basis of 40, and then she has a book basis equal to the market value of 100. For Part D, what tax basis does the partnership take in the property transferred by Lane? The partnership has a carryover basis in the assets it received, 100,000 basis in the cash from Emma, and 40,000 basis in the property from Lane. For Part E, how will the partnership account for the difference between the basis and value of the property transferred by Lane? But the partnership will treat the $60,000 difference between the basis and the fair market value of the property that Lane contributed as a pre-contribution gain that must be allocated to Lane when the property is sold or as described under the regulations. Okay, one more. We'll do 30, then we'll wrap it up. Kenesha and Shauna form equal KS LLC with a cash contribution of $360 from Kenesha and a property contribution at justice basis of $380 for market value of $360 from Shauna. For Part A, how much gain or loss, if any, does Shauna realize on the transfer? Does Shauna recognize any gain or loss? If so, how much? So for Part A, Shauna has a realized loss of 20, the 380 basis minus the 360 market value. However, the general rule is that no gain or loss is recognized on a partnership or any of its partners upon the contribution of money or their property in exchange for a capital interest. For Part B, what is Kenesha's tax basis on the interest? It's for $360 of cash that she contributed. For Part C, what's Shauna's tax basis in her LLC interest? It's $380, which is the adjusted basis of the property that she contributed. For Part E, are there more effective ways to structure the formation? For Shauna, probably, right? Not really for Kenesha, but for Shauna, yes. A more efficient tax result would arise if Shauna sold the property to an unrelated third party for $360, recognize the $20,000 loss on the property, then contributes $360 of cash to the LLC. The LLC would then use the $360 to obtain similar property, in which it would take a basis. Of course, that assumes that transaction costs would not be significant. So if there's commissions or fees to pay upon the sale of that or the purchase of this new asset, that might change the answer, but that would be a more efficient way to do it. Okay. This chapter is all about partnerships, how we form them, operate them, and the basis primarily thinking of what happens when individuals contribute property to a partnership to get it started. And so always, as always, make sure you read chapter 10. That'll help quite a bit.